So in the last video, we looked at fixing your position size so that you limit your risk per trade and let your edge compound over time. But so many traders make another fatal mistake. They place a good trade, but they don't understand the difference between normal retracement and reversals forming within the structure that they're trading. So that means they dump positions too soon, or they stay in positions that just get stopped out. So I want to show you how to spot this on the chart so that you can avoid falling into this trap. So first and foremost, what is a retracement? The definition is a temporary move against your trade direction within an active price leg. So when you have order flow or a price leg like we looked at in series 2, price normally pulls back into the internal range liquidity in that leg before continuing towards your higher time frame targets. What you don't want to see, what it is not, is a reversal. Reversals close through your structure. They break swing points, they shift order flow. The thing is, retracements respect structure and then continue. So what we don't want to see is structure changing, which could mean that price is about to reverse. And this is how it typically looks. So right here we have two scenarios. We have retracement, normal retracement, and then we have reversals forming. And there's subtle differences that you need to look out for. So right here we have a buy candle and then price sells off. We have the formation of a price leg, bullish demand in the market and then sell off. So this becomes our order block, the last buy before the sell. We also get a fair value gap because there's an inefficiency left in price, the gap between candle 1 and candle 3. Price comes back, looks aggressive as it retraces into the structure, but ultimately it respects the order block and it also tags the fair value gap without closing above it. Then price consolidates and continues. So what price is doing is it's trying to essentially manipulate new longs into the markets on lower time frames right here. So this can be quite painful if you have a bearish trade here because you're seeing price test your position. But ultimately, this is normal retracement and price will continue. What reversals typically look like is where you see structure shifts. So this is an example where you have the buy to sell, the price inefficiency left. Price comes in and tags it, but then just trades straight through and closes within the bearish structure. And what often happens is it will then leave a price inefficiency in the opposing direction with a new sell to buy, a bullish order block. So this looks more like now a reversal where price is shifting order flow and we're going to tag the internal range liquidity in the newly formed price leg before continuing higher. So if you're in bearish trades right here, you don't want to get trapped and then get stopped out. So essentially what we're looking for in the charts is what is normal retracement versus an actual sign of reversal. And that's what we want to be able to identify so that we can manage our trades effectively. So let's just take this example on AUDNZD. So we're trading, as I say, the 12-hour time frame, and I've got behind here the 2-week candles that are printing beyond our 12-hour price action. So what price does is it expands in this 2-week range, then breaks above the previous candle range, and then closes inside the previous range. You see the close happens right here. So we have price sweeping a previous candle range and exposing a higher time frame target right here. So this could be accumulation, manipulation, distribution to the low. So as price starts to sell off here, we get this leg here, this order flow leg. What we have is the order block right here, which is the last buy before the sell. We also get the formation of a price inefficiency or a fair value gap right here, and it's bearish, so I'm going to mark it in red. You see there's a gap between candle 1 and candle 3. We also have buy to sell. So this looks normal. For continuations, if we want to get involved in this short, we might want to either wait for the fair value gap to get tagged or take the order block as our entry. So we would look to get short with our target being the opposing end of the accumulation candle that was manipulated. AUDNZD. This would be nearly a 3R trade. What happens though? So we get this retracement, we get tagged in, which is great. We get this sort of consolidation, but then price breaks away. So this is expected behavior. We get the formation of a new order flow leg. Now this doesn't close through the original structure, it closes within the structure, but we do still have the formation of a new order block right here, and then a new fair value gap, an inefficiency in price here. So what we're expecting is that price retraces in and then breaks lower. But that doesn't actually happen. What actually happens right here is that throughout this 2-week period, we're seeing resistance at this level. We're not seeing a sell-off that we'd expect. Instead, we're seeing price trade below what was our manipulation candle. So what this is potentially doing is turning this manipulation into accumulation, manipulation, distribution to the high. And we see it very subtly right here. You see price creates an inefficiency as it reverses into this structure. So the order block, the fair value gap gets closed into. We then get the formation of a new order block, which I'll mark actually for consistency in the same color. So this is a sell to buy. Then we also have a gap between candle 1 and candle 3, which I'll just expand right here. This is now not bearish, it's bullish. So price, as you see, sold off, retraced, this is normal, sold off, expected, then created new order flow into the internal range liquidity that we're expecting to be respected. The key bit here is it's doing it at the low of a previous 2-week candle. So we see then price comes in to the internal range liquidity. It sweeps below but never closes below the structure. And as soon as we get this close here, arguably we can look for longs because we are respecting the structure. Maybe you just want to cover that sell wick there. Where can we target? The new high. Because what's also happening is this candle is closing. So at this point here, as soon as it closes, this manipulation of this candle is complete. It's confirmed. We have order flow in our trade direction. And so we can then look at longs, and this would turn into a massive 4+R trade. Just to complete this, if you then look at how price respects structure as it distributes towards the newly formed high that we're targeting in the market, you see price creates order flow legs or price legs where you get sell to buy, then normal retracement into this bullish fair value gap, which I can also mark right here. This would be another valid entry, and you see how clean it is. Price retraces in, respects structure, and then moves up. What happens again? It just does the exact same thing. So I think there's a very small order fair value gap right there. I'm not going to mark it, but you see price trades in and away. Price trades in and away until we take the target. And actually price runs much further. But these are normal retracements. This is what we want to see in our order flow legs or price legs so that we can actually get involved in new moves in the market. What we don't want to see is order flow or structure working against us at key levels, which are higher time frame candles. So this gives us a clue, which we're going to cover next, as to when to potentially exit trades early in order to protect our win rate and our trading edge. So I'll see you on the next video.